Good morning, ladies and gentlemen. Thanks for joining us today. I hope you find the next 2.5 hours as enthralling as I expect. We will certainly find it. These are certainly interesting days, aren't they? This has been a time that no generation's ever faced before. And actually, there's probably been no more important time to share knowledge and to come together and collaborate as today. And that's really what today is going to be about sharing knowledge, exploring different ideas of how we're going to come out and hear the forecasts. What do people, the experts, really think is going to happen over the next few months and years as well? There's a famous old quote by Martin Luther King that said, we do not define history, we are defined by the events of history. And I think that will be particularly true at this point in time. I mean, the hard truth and the brutal truth is we probably have some real challenges coming our way. It's going to define many companies' future and many careers as well. But what we are finding, there's a real optimism around the place, a real desire to try to find new solutions and to collaborate in a way that perhaps has not been the case for many years before. So we think this is actually a really interesting period of time, I put it in inverted commas, and actually really offers us an opportunity to work together and actually learn together as we progress. So welcome today. I really hope you enjoy what's coming. I'm delighted to welcome in the introduction with me both Russell Kett, the chairman of HVS, who's become a great friend and colleague, and James Salford from Bird and Bird. James, would you like to say a few opening words?
Yep, thanks, Chris. As you rightly said, we're in unprecedented times. I think those of us who've been in the hotel industry for a number of years have never seen anything like this. We as a firm have spent the last few months across our international offices advising hoteliers and lenders and brands all around the world about the impact on the virus. I think one of the residing themes from the feedback we've had from our international team is that every country has been affected in different ways. We're seeing our Chinese offices beginning to emerge from the crisis and hotels beginning to open there. And some of the lessons that we have picked up from them, we'll pass on. Similarly, within Europe, our Italian offices have been affected very badly, as have Spain. So it's really been a sort of global impact with every country impacted uniquely. I hope you enjoyed today's session. There's a lot of interesting speakers who will hopefully not only talk about what's happened, but really talk about leading the way forward. And on that note, I'll hand over to Russell.
Thank you, James, and good morning and welcome, everybody. It's great to see so many people are joining us today. Thank you for attending and all those who've kindly agreed to take part as speakers and panelists. On behalf of HVS, we're delighted to have teamed up again with Karen and James of Bird and Bird and Chris Sheppardson of EP Hospitality and his colleagues to present this seminar. They and their colleagues are a joy to work with. So, ladies and gentlemen, this lockdown seminar is for you. We've got three main objectives. First, to enable everyone to learn something they wouldn't otherwise have learned today. Second, to focus on three aspects of the current lockdown: F&B, finance, and reopening strategies. And thirdly, to answer your questions as well as those the moderators have prepared. So please use the Q&A function to register your own priority issues. We'll do our best to answer them during the sessions, and if time doesn't allow, where possible, we'll send a written response afterwards. Our goal is to stick to the timetable, not least because your time is important. And so here's Chris again to present some initial questions for you to answer.
Thank you, Russell. That's very kind. What we want to do today is make this as interactive as possible and to get your views. So as we go through this morning, there will be, I think, 13, 14 different poll questions asked of you. So we're going to start with three to see how we start off. So can we bring up the first poll, please? So please indicate which part of the hospitality sector you are most closely involved with. And we have 20 seconds to answer this question. And that's the results. That's an interesting start. Can we bring up the second question, please? Please, which, no, wrong one. When do you think that hotel occupancy levels in your location will be back to 2019 levels? So 2021, 2022, 2023, 2024, 2025. (2022) seems to be the majority answer. Very interesting. And 2023, 30%. Thank you very much. That's very interesting. The third question, please. When do you think the hotel average room rates in your location will be back to 2019 levels? Again, 2021, 2022, 2023, 2024, 2025, or later. So 2023 seems to be the majority answer. Very interesting. It'd be really interesting to hear the speakers as we come through today to see where their views on this as well as we progress. Thank you very much. Very interesting. I hope you enjoyed today. I'll now hand you over to Russell, who will introduce the first speaker of the day. Thank you very much, and I look forward to seeing you later on.
Indeed. Thanks, Chris. So, ladies and gentlemen, our first session focuses on the key economic implications of the aftermath of COVID-19 and is presented by a gentleman who will be well known to many of you, I'm sure, Paul Slattery. Paul co-founded Otus & Co. in 2002, having previously spent 15 years with Dresdner Kleinwert Wasserstein, where he built its hospitality reputation as one of the market leaders among stockbrokers. Of particular note, Paul advised the Compass Group in 2000-2001 on its disposal of the Forte hotel brands, the then largest ever hotel chain auction. Prior to that, Paul has been an academic at Huddersfield University and has worked for several hospitality sector companies, including Trust House Hotels, Canadian Pacific, and the Rank Organization. Paul, we're delighted to have you with us this morning. Thank you so much indeed. We look forward to what you have to say, and thank you again.
Thank you, Russell. Thank you, Russell. Good morning, ladies and gentlemen. I can't see you. It's not comfortable. For some of you, the material I'm going to deliver to you will be new. I make no apologies for that. I hope you find it useful in making your way in the unfolding economies that we're just beginning to confront. Let me bring up some material here. Lauren tells me that there's a few seconds wait in this before it arrives. I hope it comes. We've got difficulties if it doesn't. Lauren, is it coming now?
We have it, Paul.
Yes. Good, thank you. Right, let's move on. Let's get on to the first substantive thing. Don't worry about all this mush that there is in here. This is going to be made available to you. I want to simply highlight some of this stuff.
Paul, you just hit presentation mode before you, so that the screen looks bigger.
Ah, okay. Aha! Nobody told me about presentation mode buttons. Where can I find that?
Bottom right-hand corner on my screen, anyway.
I've pressed something there. Is that it? No, that's questions.
Maybe at the top, hit slideshow.
Okay, plus share, stop video, mute, remote control more, record, disable, share computer sound,
No,
optimize.
no. Below that, slideshow.
I don't have that.
Well, according to your screen, you do.
Ah, I'm damned if I can find it.
Your arrow is there now.
Where? Here? It goes chat, record, meeting info, disable participants.
No. Okay, carry on. Just carry on.
Share computer site, optimize. Okay, hold on. Found it. Optimize share for full screen video clip. Is that it? Is that it?
Just carry on, Paul. Just carry on.
Okay. Anyway, we're starting here with what's happened since the Second World War. To give you a context, the primary and secondary sectors, as you can see from the chart, in the UK, France and Germany have declined in their employment. Why is that important? It's important for several reasons. Employment in sectors are a reflection of spending. Our spending in these sectors, that is on groceries and on consumer goods, has been in decline because of growth in productivity and in less expensive imports. Now, why is it important for us? It's important because these two sectors, and recall that the primary sector accounts for only about 1% of employment. It's de minimis. However, the primary and secondary sectors, employees and their families, are the lowest yielding for hotel business demand and for hotel leisure demand. To give you an extent to how far they are away from that, you can see that, well, if you're a retiree in the UK, it's going to take you 4 days gross income to buy one night at a Premier Inn. When we are looking at coming out of the sector, coming out of the pandemic, these two sectors are the lowest risk to restart. They'll be the first to restart. Parts of them have never stopped. The problem is they will not save the economies. And also, as you can see from here, the reopening in Germany will give a more immediate uplift because these sectors are more significant in Germany than they are in the UK and in France. Now, what's going to happen in the post-pandemic area? Not a lot. This is a powerful, irrecoverable trend in these two sectors that will not come back. That is good news for us in the sector because they hold little impact. Moving on now to the public sector. I'm not going to spend much time with this. You all know what it is, but as you can see, they are more significant, much more significant in employment terms than the primary and secondary sectors. Their families and employees are much more significant markets for the hotel business. You all know what's happened with this sector during the lockdown. In the post-pandemic era, the pressure that the public sector has been under over the past 10 years is likely to continue. Probably healthcare will have more money thrown at it, but generally there'll be tight budgets. That is going to constrain the rate of growth, which is projected to grow probably in line with populations which in themselves are declining in growth rate. This is not going to be a bonus sector for the hotel business. It will grow, but only marginally. Now we get into some of the more interesting stuff. The service business sector, different pattern of graph there. The sector includes retailing, financial services, communication services, professional services, and personal services. This is the largest sector in the UK and the second largest in France and Germany. It is the most significant sector of the economy for the hotel business. It's the highest yielding for business demand, and it's the largest market for leisure demand into hotels. This is the biggest sector for working from home during the pandemic. However, if you look closely at the graphs, you will see that from the turn of this century, there has been a cresting in the growth in the share of national employment in each of these countries. And that's happened for several reasons. It's happened because of the switch from in-store retailing to online retailing, to the maturity in the communication services markets. We've all got phone and broadband contracts. There's only price increases that are moving that along. And importantly, it's happened due to the decline in financial services because of the reverse in home ownership. Now, when you have a sector that's as significant as this for the economy and for the hotel business, and when it's cresting as it is, we have to become concerned. We have to be concerned, is there anything that can bring that back up again? Or is this a precursor to decline? And if it is, it's jeopardizing growth in the economy and jeopardizing growth in business demand into hotels. Too few people have paid too little attention to this dynamic, and we do so at our peril. If I move on to the experience business sector in which we're located, these are broadly all of the sectors that were immediately closed: travel, hospitality, sports clubs, live sports spectating, cinemas, theatres, blah, 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 blah. Graph here again looks very different from the others. The difference between the economies is much more marked. The UK is much more significant. Germany is much less significant. There's a whole host of reasons to explain that. I can't get into them all at the moment. But the important thing here is, since the beginning of this century, the experience business sector in each country has been the fastest growing sector for employment. And recall I mentioned earlier, that's a reflection of spending. This is the most difficult sector to deal with during the pandemic. We all know that. Even governments knew that. Which is why they closed us down. Let's look at coming out. Hotel chains have rushed to clean, to train their staff, to look at how they can organize physical distancing. These are fundamental to reopening. However, ladies and gentlemen, they are insufficient. They do not de-risk infection sufficiently. Without all customers and employees being tested on every arrival and every departure, as well as contract tracking when that becomes available, hotels are insufficiently safe. I also note that in my discussions with hotel companies, there's been a reluctance in many of them to spend the money to do all of this. How can we possibly test all of our customers? How can we possibly control customers like that? Well, if you don't and you're not going to do this, please let the world know that your hotels are insufficiently safe. We are at a crucial stage in economic history, ladies and gentlemen. For the first time, as we come out of a period of trauma and the economies change their shape as they have done in every instance in economic history, the post-pandemic area will be the experience business era. as more perceptive of you will have seen in all the previous charts, there has been a decline or a cresting of employment, except in the experienced business sector. The economy now needs the experienced business sector to grow, not only to grow, but to accelerate. The question now is what policies will need to be enacted for us to achieve this acceleration and, quite frankly, to save the economies. Let's have a look at some. Some of these you may well consider strange. Bear with me. The first significant development is to increase the owner occupation of homes. This is not fully appreciated, and it's not just that you own a home. It is because you have access not only to short-term credit through a credit card or unsecured loans, but that you have access to long-term credit. You also have the situation in which there is, in most instances, certainly in the UK, France, and the US, there is residential capital appreciation, which benefits you and gives you flexibility in the management of your finances at different stages of the family life cycle and the career life cycle. Homeowners have the highest incomes and the highest debt capacity. They are the main market for hotels. Home renters, significantly less of both, of all. The source of new demand for hotels is the 21% in the UK, 31% in Germany, and 24% in France who are stuck in home renting. They are the middle level income people. These are the people who naturally became homeowners in the last quarter of the 20th century, but were stopped when it came to the banks raising and repaying mortgages onerous after the Great Recession. Importantly, this group also includes young professionals who have been saddled with student debt, which has made them a higher risk to banks and have a lower lifetime value to banks. They are rammed into renting and many of them have been unable to buy their own home. That is a major blockage on the growth in demand. To give you an example, if all of those folks were able to own their homes, by the time that happened, it would increase the total market size from less than half in the UK to 2/3 of the population. That's the market size for experienced business sector, and then within that you can put hotels. Without it, growth in domestic demand for hotels will shrivel. The second piece that we have to consider is inbound visitors. We've made a mess of managing international demand. The UK is among one of the worst in the world. We have basically double the number of outbound visitors than we have inbound visitors. Germany is not too different. France is the other way around. They have high volume but low spend inbound visitors. They spend per head about half of the UK inbounds. We need to get more of those visitors. The governments are not spending enough, not focused enough on achieving this. To give you some examples, in the UK we have the airline passenger tax, which last year raised 3.5 billion on all passenger fares leaving the UK. That was 50 times, listen, 50 times the amount that the UK government spent on attracting foreign visitors. It doesn't make sense. It's senseless. there needs to be substantial, significant increase in inbound visitors to produce that growth in demand for service businesses, because for experienced businesses, because inbound visitors demand mostly is in the experienced business sector. Next, if we're going to have that growth in demand, which will be electric, we're talking a new golden age for experienced businesses, a new golden age for the hotel business, nothing short. We will need substantial increase in travel infrastructure, not the pussyfooting around by governments seeking not to spend on travel infrastructure. What's the worst that can happen? The worst that can happen is nothing. If we maintain all the corporate policies and the government policies that has got us to where we are at present, it will not allow us to accelerate demand, accelerate employment, accelerate contribution to GDP from our sectors in the post-pandemic era. In the reverse, it will increase unemployment, it will reduce spending and produce weak economic performance for years. It's not attractive at all. Give us the golden age instead. Thank you.
Paul, thank you so much.
Paul, thank you. And now I'd like to introduce Robin Rossman, Managing Director of STR's international business across Europe, Asia, and Latin America. Paul's going to give us an update on what we're seeing globally, and I will hand over to him now. Paul, are you on?
Robin.
Perfect.
Yes. Hey, James. Thank you very much, Paul. Always great to follow you, because I was going to share some pretty depressing stuff, but I think actually you're going to make it sound pretty optimistic now. So thank you. Let me just share my screen. Oh, don't want to do that. All right. Can I just get somebody to confirm they can see what I'm presenting?
Yeah, we can. Thanks.
Wonderful. And Russell, when I'm presenting this and I get too negative, you please do jump in and say, "Come on, Robin." It's not going to be that bad, right? So I'm going to, in the next 15 minutes or so, just from a hotel performance perspective, do a quick dash round where we are in terms of recovery around the world, and particularly in Europe, and then what the future might look like. I have been presenting quite a few of these on our sort of bi-weekly webinars. So if you have seen some of this before, I do apologize, but there is some new fresh stuff in here. I'm going to start off, I usually end off on this one, but I'm going to make some statements in the next few slides, which are in no way intended to suggest anything around what we are telling people to do on pricing, but it is what we're analyzing based on the facts and what's happened in the past. And I'll start with a sort of positive statement. And this is a statement of many of the CEOs of global hotel groups, but it is also something I truly believe, and that is in the long term, travel and tourism demand will come back, and we will eventually get back to and surpass the levels of demand that we saw in 2019. So it's important to recognize that, yes, it's a bit of a hammer blow at the moment, but I personally don't believe that the demand for travel will go away over time. And that, for me, is less about necessarily individuals taking more trips themselves. I think individuals might take less trips, but I think the population of people traveling will grow, and that's ultimately what will recover that demand in travel. But with that being said, you know, that recovery will take a long amount of time, and it will look different for different people, because, you know, recovery for Marriott or Hilton getting back to 2019 levels is not necessarily the same as recovery for an individual hotel somewhere, because they don't have the same growth drivers. And during that time of recovery, demand is going to be well below what we saw in 2019 levels. That seems like a statement of the obvious, but it's a pretty important statement because when you think about the second law of thermodynamics, so there you go, Russell, you asked me to show something new, and I don't know how many people know the second law of thermodynamics off by heart, or certainly how many expected to see it in a hotel performance presentation. But it actually is important. It's important not just for hotel performance, but it's important for pretty much everything in the universe and everything that happens to us in the economy. So why the second law of thermodynamics? Well, I put the which I'm not going to read out, but really at its simplest, the second law of thermodynamics explains why, when you take an ice block out of the deep freeze and put it on a table, it melts. It explains why we only ever get older and never younger. It explains why once you've cleaned a room, it never stays clean, it becomes messy. And it is because there is a natural tendency for high energy to move towards low energy and to move towards an equilibrium, is a way of putting it. What does that matter for us? Why does it matter for hotels? Well, what we've learned from every single downturn that's ever happened in the hotel sector, or indeed the economy, is that where you have less demand, the people that are left for demand, and in a hotel scenario, the way they inevitably end up doing that is price. And I've not talked about rates and price in the previous webinars that we've done for good reason, because it's important not to jump to conclusions. However, if, as we expect, that what we're likely to have for the next, certainly this year and next year, is a period of pretty depressed demand due to travel restrictions, social distancing, and then some more fundamental medium-term headwinds with the restructuring of the airline industry. And of course, the biggest question of all, the impact of an economic downturn and, ultimately these huge job losses that we're seeing all around the world. I think there's no doubt that there is going to be depressed demand for a period longer than what we saw in the global financial crisis. And during that time, it is unfortunately inevitable that hotel rates will decline. They'll decline in some instances just because of a function of them being high occupancy markets, where previously hotels would have been charging premium rates on nights that they were sold out. So those compression nights, if you think of Edinburgh during the festival, Dublin, there are lots of markets around the world where there will be rate declines purely because occupancies are not getting up above 90% anymore. And then on top of that, we will have competition and the second law of thermodynamics, which will push and depress prices down for far longer than we saw in the global financial crisis. And so that really does impact what we expect the shape of the recovery to look like for hotels. But before I get to that conclusion later in the presentation, let me just make sure we're all on the same page as to where we are now. And where we are now is obviously still loads of hotels closed around the world. This was the end of April, as at the end of May, just updating the data at the moment, but I can broadly say it's unchanged from these levels of closures around the world. However, we are seeing significant reopenings coming through in June and July, particularly in Europe, where obviously many of the closures in the world have been. What about hotel performance? Well, back in May 17, this is a fairly harsh picture of what the world looked like for hotels, red being markets with forced closures, orange being where hotels were allowed to be open, but there really was no demand, and then yellow where there was some domestic leisure, green some domestic business, and there was none of that at the middle of May. As we move to the end of May, you can see a brighter picture, less red, more hotels allowed to open, some domestic demand coming back in North America, and some business demand in China. And you can see that when you look at hotel occupancies around the world. I mean, none of these are good, but some of them are certainly less bad. And China and North America leading the way in less bad on a participating open hotel occupancy However, there were loads of hotels closed, as I mentioned, and if you add that back into the picture, so this is the occupancy of all hotels, including those that are closed, you can see pretty bad around the world, with Europe and Southern Africa leading the way in terms of lowest levels of performance. So that was the end of May. We're some way on from the end of May. What does it look like now? Well, as at the end of June, broadly the same. So I'll go back and forward a bit there. You can see a couple of percentage points change, but we are still very much at the bottom in many countries. And as you can see here, looking at rolling occupancy, China leading the way, had the virus under control certainly 2 months before anybody else. And you can see occupancies back up to about 50%. United States, Middle East, around about 38%, with the US recovering quite fast. And the Europe's performance probably best described as analogous to a log lying on the floor, which is flat and not really moving until very recently. And I'll dig into that later. Before I do, though, if we look to the path forward, we always point towards China. You could say China is not a great comparison to the rest of the world. However, SunTrust did a recent analysis of the correlation of performance of certainly China and the US and found something like a 95% correlation in terms of the shape of the recovery, even though obviously the US never dipped as far. So I do think it's a good indicator. And China hit occupancy, 15% occupancy, where Europe is now 3 months ago. And so I think we can hope that something like 3 months from now, Europe will be back up at that sort of 50% occupancy level. The question is, when we get there, will it continue to recover? And China has seen a sustained recovery for the last 3 months or so, but it is flattening out. It is, if we look at May, we can see that it hit around about 50%, and it is flattening at that level. And I do think it will recover a bit further, but there undoubtedly for me will be a plateau at which occupancy levels stabilize until there is a full recovery of international travel and indeed recovery of economic performance. So what about Europe? No surprises, shared this at a greater level already, but certainly in terms of world perspective, by far the greatest levels of closures, with governments taking quite strict measures to restrict travel and in many countries just close the sector. This was closures at the end of April and percentage of the total market, and it was broadly unchanged towards the end of May, with some hotels opening up, certainly in DACH, less so in UK, Spain and France. Although we do expect that to change this month and next. In terms of hotel occupancy, you can see here pretty low in April, even worse when you add back temporary closed hotels. And looking at open hotels for the month of May, still pretty low. Not much there to get too excited about. However, in recent days, there have been finally some green shoots, particularly across Germany, Switzerland, Netherlands, and Austria, where we're starting to see that first sign of life coming back. It's that weekend leisure demand, particularly the sort of final weekend of May. Some specific countries showing some bounce back there. And then when you dig into those countries a bit further, you can see some individual markets or sub-markets within Europe getting back up to, in some cases, occupancies close to 70% or over, although that certainly is still the exception. And where demand has been, it has been that sort of weekend leisure demand so far. We haven't seen the full business demand coming back. And when we look at business on the books into the future, the story is pretty similar there, that when we got to the end of May and we looked at the pickup over the last month, it was still broadly negative. So more people cancelling rooms than booking rooms, and not a whole bunch of business on the books left at the moment. However, we do expect that to recover during the course of June, as finally now, particularly in countries like Germany, there is increased confidence with consumers to start booking again. So getting back to where I started and what the recovery is going to look like, well, it will depend on the market you're looking at. And those markets which have an increased reliance on long haul or foreign arrivals will take longer to recover. And those that have more of a domestic demand base are likely to be less volatile and have a faster recovery. So nothing revolutionary there, but important to note. What about the recovery? Now, I'd like to be super positive. I'd like to be as positive as those global CEOs and say it's going to be something like 2023 or 2, where there'd be a recovery. But based on the latest forecast that we've released this week, and I don't have granular detail on the numbers in here, but what I can share is an overview, is we are expecting it to take a little longer. We're not forecasting a second dip. Let's just pray that that doesn't happen, that there isn't a resurgence of the virus in the winter, and that it looks something more like this, where we do have a recovery in the next 4 to 6 months, similar to what we saw in China, that gets us up to a level of occupancy around that 50%, whatever it is relevant to the market based on its sources of demand. And then probably a drag at that level until there is some kind of cure or permanent control of the disease, and only then we'll see a full recovery. However, in that time, that's a long time. That is a long time, stretching all the way through to middle of next year. Performance will be depressed, and we expect that it will take longer for certainly group demand and much business demand to come back to the levels. And during that time, there will be significant competition. And so if we want to compare against the recovery from the global financial crisis, whilst I would love, and I really do hope it's better than this, I think that's probably overly optimistic. Why? Because we already know that performance has fallen far further and far worse than what we saw in the global financial crisis, not just for hotels, but also for the economy. We also know that demand is likely to remain depressed, as I've said, for the next year, with all these social distancing controls and other controls in place. And then, you know, whilst I haven't seen many economic forecasts suggesting that it's going to be much worse than the global financial crisis, I still individually, personally find that hard to believe that it isn't going to be. And certainly our forecasts are suggesting that the recovery for hotels is likely to take at least as long as what we see here for the global financial crisis. And so there is a recovery. It has started around the world. China's led the way. The US has recovered far faster than Europe. Makes me a bit jealous, but there they are. They're doing it. And Middle East and Australia haven't been as bad. So recovery has started, and Europe recovery has also started, even though it has been worse and taken longer to get going. I do think it will recover and improve in the coming months. But recovery isn't the same as getting back to where we were. Recovery just means we're not closed, and we can at least get some people in the hotels. And I think it's likely to be a painful recovery. We expect it to be slow and to take a similar or longer time than the global financial crisis. But that's just a scenario based on the assumptions I've set out. I certainly hope it's better than that. And on that note, I'll stop.
Thank you, Robin. That was excellent. Very inspiring indeed, or very interesting and thought-provoking indeed. So thank you. I'm delighted now to try and introduce the first panel, which is going to particularly focus on food and beverage, and actually how we see food and beverage services recover or not recover, or how they're going to change as we move forward. And I'm delighted as we do that to introduce a very experienced panel to come and talk to me. But first, we have another poll that we want to ask you. Alex, can I ask you to put the poll up? So out of interest, which food and beverage services will be the first to recover, do you believe? We're given 8 different options there. Now, this is broader than just hotels. We're looking at the whole marketplace. So it'd be interesting to see your views. So fast food recover first, very interesting. Fine dining only 3%. That's very interesting. Pop-ups only 3%, but delivered in 19%. No, that's very interesting. Thank you very much indeed. Before I introduce my panel, can I just say paused slides from the first session are certainly available for anyone who would like them, and we'll certainly be delighted to circulate them afterwards, and I'm sure the same with Robin's as well. But first, can I introduce the panel that's going to talk with me at this point? We have four great panelists. First, Michael Gottlieb. Michael is probably one of London's foremost restaurateurs over many years. And it's probably a very well-known figure and have some obviously very interesting views to make. Abigail Tan, who's the Chief Executive of the Giles Group of hotels, operating both hotels in New York and in London, and obviously grew up in Malaysia with hotels out in Malaysia, and is probably seen as one of the real emerging voices in the hotel sector. So delighted to introduce Abigail as well. David Reed, Chairman of Prestige Purchasing, who is never short of some fascinating figures and facts as well. And is probably one of the most experienced figures of working across all the sectors from a purchasing point of view, and therefore brings a different perspective. And finally, but not least, Adam Elliott, who's one of the leading outsource providers and experts from the sector as well. So welcome to all four of you. You're very welcome.
Thank you.
Out of interest, firstly, your thoughts on those slides. And do you believe fine dining will take 3%, only 3%, will take longest, and fast food will be first back? David, you have some views on this?
Well, I think if you just look at what's happening in the dining sector right now, a lot of businesses are opening up with, traditional casual dining businesses are opening up with just takeaway, click and collect and delivery. So I think that's a pretty good sign that that's the way it's heading in the short term. And over the next few weeks, of course, we'll see a bigger drive towards diners in restaurants as these social restrictions change. But yeah, I think it's definitely the way it's heading right now.
Michael.
Yeah, the same question?
Yeah, absolutely. I mean, restaurants is going to be a hard recovery, isn't it?
Extremely. I think the hardest of all, in many respects, I think even harder than hotels. But there's no doubt fast food is going to be the first to recover. And that's why the overwhelming number of participants here voted on that, because they're already trading in some respect. I see queues outside McDonald's, and people will go there because of the convenience of it. And I think following that will almost be the casual dining sector. I think that'll follow second, but very, very slowly. And fine dining for sure may be last. The only thing going for fine dining is usually you have more space between tables. So perhaps that'll be an advantage to some people. They feel safer. But I think it's not the death of fine dining, obviously, but it is going to hurt them, I think, more than anything.
So how do you see the restaurant sector adapting over the next year or so, next 2 years?
Well, how do I see it adapting? Well, there won't be as many surviving to adapt. I think a lot of them are going to be out of business, far more than many people anticipate. And it's a shame, but I think there's no getting away from it. Even deciding whether to reopen becomes difficult. And yesterday we saw that the Ledbury had decided to close forever because they couldn't even make it at 1 meter social distancing. And a lot of people have no idea, even if the rules are completely relaxed, I think there will still be a huge number of casualties simply because the return is going to be much, much slower than anticipated. And I think looking at the results as one has seen on Propel and some other forecasters of what has happened in other cities is not necessarily going to be the analogous to what's going to happen in this country. It's going to be sector by sector, geographic sector by sector. The city is dead as far as you can see. Canary Wharf will be dead. People are not going back to work until the new year. It's going to be, I think, of all the sectors, we are going to be the most seriously affected in the long term. It is true that there has been it's been a long time coming. There needed to be a shakeout. There are too many restaurants, there's no question. This has just hastened it far more than we need, but it's going to be rather unfortunate.
Thank you, Michael. Abigail, can I bring you in at this point? I mean, one of the arguments is that hotels will be seen as safe places. And actually, there could be a real resurgence in hotel restaurants being used and customers feeling comfortable. Do you believe that will happen, or do you think that it's going to be still a long, hard drive back?
Yes, I mean, echoing what Michael and David said, the faster casual dining, I think we'll see the faster recovery just because of the convenience, the affordability, and just the availability of those restaurants. The space, the social distancing will be an issue, and whether hotels will be seen as safe havens for restaurants. I think it could be a bit of a mix, because hotels, like restaurants, also will be adopting the health and safety and hygiene rules. So for us, it's a matter of using those, as well as how restaurants and hotels can provide a better service in order to attract the clientele back.
So are you going to be focusing on service and providing that better service as one of the key differentials?
Definitely, yes. On top of the hygiene, of course.
Of course, naturally enough. Adam, can I bring you in here? Because actually the other argument is that for outsourcing, there's a real opportunity. And actually, for hotels to bring, there's a natural marriage to happen between outsourcing, F&B outsourcing, and hoteliers.
Absolutely, Chris. I think this is a great opportunity in terms of where we stand at present. And I think, without being disrespectful to any hoteliers on the call today, I think this will allow hoteliers, hopefully, to embrace with outsourced people like ourselves, and that's a specialism that we do, to actually bring some of that specialism back into the restaurant and the bars, and actually give the hotels that differential in terms of space. People outside are going to want to go to a safe environment and eat and drink, and they're going to want to know that it's clean and safe and it's got all the right recommendations and badges and so on and so forth. But at the same time, once you're in there, you've got to still give an experience, and it is about creating that experience within that sector. So I think, certainly hoping from our position where we sit today, that there is going to be some pretty good opportunities out there. And to be fair, in the last 2 months during lockdown, we've certainly seen some pretty good opportunities and are discussing some pretty good opportunities.
So David, coming to you, we obviously had a discussion a couple of weeks ago about this kind of issue, and you see there has to be a whole change in how people look at menus and food costing and P&L of F&B. Is that fair?
Yeah, I do. I think if you look at where we're headed, volume is undoubtedly going to be a real challenge for every F&B operator, no matter what sector they're in, because we're going to be in a position where we've got a pretty thumping recession, social distancing, the fear factor, and so on. And while there are some opportunities around day parts and new channels to market, the reality is we're going to have less bums on seats. So there's not much opportunity there. There's not too much opportunity on price, as Robin was pointing out, and that applies in F&B as well. Because of the recession, there'll be discounting, there'll be low inflation. So really, if you look at the levers that as an operator you have to pull, you can't pull the price or the volume levers very much. So cost of production is really the only other major driver of profitability. And I think there is a complexity opportunity here in the sector. And what I mean by that is the removal of complexity where it adds little value to the customer, i.e. it won't, if you take the complexity away, it doesn't drive up price or doesn't drive up volume. And the sort of things that I think there are real opportunities in the market are things like make or buy. To what level of pre-preparation do you buy product in at? What level of dish ranges do you have on your menu? Because every time you add a dish, you do increase your labor cost and increase your food cost. Ingredient ranging, delivery frequency, and actually how much you change things, all add complexity and all add cost. And I'm not anti-complexity, but the opportunity I think is where it doesn't add value, and that's the thing that operators need to look at.
Oh, that's fair. And so, out of interest, do you see the delivery model and partnerships with delivery model growing as a result of this? Because that's a natural partnership, isn't it? Relationship.
Well, yes, and I think the other key thing for me is most hotels were built in a bygone era. In fact, most hotels' space utilization is kind of a bit outmoded even in pre-pandemic. But post-pandemic, I think there's going to be some real challenges around sweating the asset, sweating the square footage of a property, and in particularly around kitchens. How much are you getting? How much profit return are you getting out of your kitchen? Can you look at other channels to market, as you're suggesting? I think banqueting kitchens might be very suitable, for example, for dark kitchens when they're not in use for banqueting, which will certainly be for some time. So I think looking at the whole footprint of the hotel and saying, how do I sweat this to the best ability, is going to be a major opportunity for hotel operators.
Now, we have a question coming in from the audience about food markets. Do you believe food markets will become more important and play a bigger role?
I'm not too sure I know what food markets mean. I don't know whether anybody else has got a reply for that.
It's more about how you use large spaces. And I suppose actually one of the interesting things ties in with event spaces. Can event spaces be used in a different way as well?
Mm. Yeah, I think certainly that would be the case.
Sorry, Abigail, your views on this?
In terms of event space?
Well, are you using event spaces differently? Because conference and banqueting is going to take a long time to come back, isn't it?
Yeah. I mean, the event space that we have in our London hotel currently, anyway, is we can take larger events, but it's more tailored to smaller groups of people meeting and training events. So I think how that will change for us is just reconfiguring some of the rooms and offering just that continuing to offer that smaller group meetings that make it easier for social distancing. Where we're lucky in some way because we're not a big conference facility. It's more a very secondary income stream for us.
That's fair. Adam, your views?
Well, I think it's about being able to adapt, and I think everything that is happening at present is that you've got to be able to take the spaces that you've got and be able to adapt those spaces in today's times and meet those challenges, and without sort of preaching the obvious, when you've got an outsourced operator that is clearly focused on food and beverage, their ideas of adapting are probably a little bit greater because they will look at every opportunity possible to try and go back to the earlier point about sweating the asset. And it is about making sure that that asset is sweated accordingly, but within normal guidance. But if you can adapt your menus and adapt that space and work outside the box, you can be pretty creative. And I think that's probably the word that's really required over some of these sessions. You need a bit of a creative mind now to get through the next umpteen months to see how you can adapt your own model. We're slightly fortunate because we don't have the big oil tanker. It's a little bit easier for us to adapt. The bigger oil tanker type operations are difficult.
Don't you all think that when customers start coming back, they're not going to want to be seeing anything other than they left behind before? So people who suddenly value engineer their menus or adapt their menus by buying in products rather than making them on site, people will be disappointed when they see that, don't you think?
I'm with you. In terms of, I think there's a need to reduce menus at present just to make it safe and reliable and accessible, which I think is better. I think you still have to have that core ability to be able to cook that freshness inside those venues. Otherwise, we're no different than the high street, and then we almost then start becoming a bit sort of manufactured. And I think you're dead right. It devalues the whole price point that someone's actually going to that hotel or venue for.
Yeah, I mean, one thing I'm doing, and certainly in one of the venues that I operate, is I'm only going to introduce a shortened menu with only the best sellers on it. Ones, and the rest we just leave behind, and we'll see how it goes. We just couldn't afford the wastage that might come from not having enough customers to serve and having to throw stuff away. So, it'll be stuff that we know have sold in the past.
Can I just quickly respond to that make or buy issue? I think clearly, if make or buy is all about the affordability of the product for the customer. And clearly, if you are charging a certain price point, if you devalue the product in some way, perhaps by having it made upstream in the supply chain, then you are literally ripping off your customer. But on the other hand, if you're in certain parts of the market, you certainly want to be able to give a value product, and the customer will only want to pay a certain price point for it. And I think sometimes, as an industry, historically, what we've done is we have tried to over-specify the product, and we've charged too little for it. And I think in this market, that's going to be a really testing challenge. And I think the other point I would make is that make or buy doesn't need necessarily to be about pre-cooking. It's often simple things like who fillets the fish. And those are decisions which are often not even thought about in our market. And I think that needs to be looked at really heavily and closely now.
Michael, because obviously I'm quite conscious of the time, one question that's kind of is whirling around my mind is what's going to happen to the celebrity chef restaurants? And because if the market's going to take time to recover, it's going to be very hard for them to survive. And is there a natural relationship again for them to build relationships with hotels?
Well, I was looking, when I was invited to this conference, I was looking back and I saw that in 1987, I wrote an article for the Caterer and Hotel Keeper about how hotels are very ill-equipped in their mindsets to run their own restaurants. And to a degree, I don't think that has changed all that much. I think there's obviously been a marriage between celebrity chefs and hotels that have worked very well historically. But I think it'll have to go further than that. I think hotels will almost certainly want to explore the possibility of having much more casual dining operations in their venues, which have far less stiff types of service than historically they've been known for, and go for much higher volume places as well. Gordon Ramsay and Jason Atherton, all of those in hotels, have done the hotel sector a power of good, no question about it. But I think the hotels are going to have to be a bit braver and go for much more famous or well-known and certainly well-run casual dining restaurants in their venues.
I mean, looking at the questions coming through, you can see that there's a real view that food courts will take off in hotels. Do you agree on that?
In hotels themselves?
Yeah, I noticed there's a comment there about Hyatt in Melbourne opening a food court in the atrium.
Right. Well, that's interesting. Yeah, could be.
Abigail, your views?
Yeah, I completely agree with Michael that, and I learned it the hard way, that actually it's cheaper for me to eat in a restaurant than actually to own one. Hotels have always kind of lagged in the in running a well-established restaurant, and that's why we've actually already adopted the model for a few years now of outsourcing our restaurants to well-known restaurateurs and professional chefs. And going back to casual dining, I completely agree with Michael as well. In our London hotel, we have 2 outsourced restaurants. One of them is VQ, which is 24-hour casual dining concept, and then Hudson's House, which is a bar and grill. So, because I think, as hoteliers, we concentrate on the hotel operations. We're not concentrated on the restaurant operation, which is just as important in a way as the hotel, in order to give the right experience to the guests, to be able to attract outside clientele as well, and just the restaurateurs and professional chefs just do it so much better than I can or than we can. So it's definitely a model that we'll continue to push forward.
Can I just give a word of advice to some hoteliers who are thinking of putting restaurants into their hotels? Leave them enough space to have their own toilets on their own premises. The thing that ruins it for me when I go to a hotel restaurant is I've got to walk down corridors, upstairs to find a toilet, and often have to be accompanied by a member of staff. And that takes away the whole idea of it being a self-contained restaurant. So give restaurateurs enough space to put their own toilets in right there in the premises.
Adam, you probably agree with that, don't you? It's all about the experience.
100%. I think it's you know, it starts from as Michael said, it starts almost from the build right through to, you know, where it needs to end up. And you know, the focus and with exactly what Abigail said, and I you know, I respect it immensely. It's, you know, hoteliers are very focused on what they do best, and they do it extremely well. And in some of those areas, the outsourced market works exceptionally well as a partnership, because you've then got a good partner in terms of a food and beverage specialist looking after marketing, driving, pushing those sales, and just worrying about the food and beverage throughout the entire business, and the hotelier looking after the asset and the hotel, and the two combined should be a marriage in, you know, in heaven. And that's what you're trying to get to.
And David, do you see a marriage becoming between the high street and the hoteliers coming forward? Is there a landscape for that?
I think it's long overdue, and I think one of the things that has been already happening in recent times and is occurring more and more is that the casual dining operators are looking to diversify their portfolios in such a way that they can franchise more, they can have more JVs, they can take their product into other places, even products on the shelves in retail and so on. And I think that is the way of the future, because restaurants and bricks and mortar are certainly in this market of severe oversupply, as Michael was referring to earlier, is probably not a single way forward for casual dining operators. And there's a fantastic opportunity in the hotels market for those joint ventures to occur.
Thank you. Thank you to all of you. We're out of time, sadly. I could talk on about this for another hour. I think it's going to be the most fascinating landscape to watch unfold. So thank you, Michael, Abigail, Adam, and David. Thank you for your time.
Thank you.
Thank you. Thank you very much.
Thank you. Before we leave the panel, one final question to the audience. If we could just bring the question up. So many argue hygiene is going to be the key factor in encouraging people to return to spaces. Others argue this is seen as a given, particularly within hotels, and that service will be more important. Your view? Very interesting. I mean, it is interesting. There is a core for an industry, a standard, audit standard on cleaning and hygiene, which seems to be growing as well. So it'll be interesting to see how that unfolds. So thank you very much indeed. Thank you for your time today. And let me pass you over to James. James, are you there? Good luck. I hope you enjoy your panel as much as I did.
Thanks, Chris. Morning, everyone. As we came into 2020, I think there were more lenders willing to lend and invest into the hotel sector than I've seen at any point in my career. We had a myriad of banks, debt funds, sovereign wealth funds, foreign investors particularly, and family offices all keen to lend into a sector that had become institutionally acceptable as an asset class. Then obviously COVID-19 came along, and all of that changed. Similarly, we had some very, very highly geared deals at the back end of last year with ground rents, particularly in the UK, becoming prevalent, some senior and mezz funding all on the same deals. So COVID has really been a total game changer, and wherever we were in the past, I don't think we can take that as granted as to what the situation will be going forward. Joining me today is a panel of highly experienced hotel lenders and borrowers. So I'd like to introduce you to Michelle Weiss, who is Head of Hotels at Ariel Bank, Shona Pushparan, who formerly was Head of Hotels at Clydesdale and is now Non-Executive Director at Dominus Group, Elliott Kay, who is the Managing Director of Puma Property Finance, and Guy Phillips, Head of Hotels and Leisure at Santander. So welcome, guys. Before we kick off with the panel, I'd like to start with a question. So if we can load up the question, which is, when do we think the debt market for hotel finance will return to the levels of gearing, so the sort of high gearing we saw and pricing that we saw at the end of last year? So at the end of this year, summer next year, by the end of 2021, summer 2022, by the end of 22, later than that, or will we never see those levels of gearing again? So if you can submit your answers. So overwhelming majority think it'll be quite some time before we see those levels of gearing back again. Probably not a surprise. If I can ask my panel to unmute themselves and switch on their cameras so that we can all see you. All that. Excellent, everyone. Hi everyone. Michelle, can I start with you? We talked earlier today about the impact on RevPAR, that we won't see potentially RevPAR returning for quite some time. Similarly, valuations have become extremely challenging in terms of valuers providing any sort of concrete numbers around what hotels are going to be worth. In that context, given those are sort of two of the key drivers that all hotel lenders look at when they're making decisions as to what they'll lend, what do you think needs to happen before you can come back into the market and start lending again?
Well, I think, look, obviously, as you mentioned just before in the introduction, the landscape has changed quite dramatically in the last 3-4 months. Before we saw a lot of lenders coming in, the asset class has not been perceived as an alternative class anymore. I think the cash flow, the income has been looked at as a certain income. And obviously then Corona happened and the cash flow has been impacted quite significantly. I think that there are, though, I mean, we are continuing lending now. We're committed to the real estate, to the asset class. I think there are lenders that are committed to it, that do understand the business behind it and understand that obviously there are cycles and that performance can go down of hotels. And while obviously we haven't seen something quite as significant as we're experiencing right now, with I think the slide said 76% of all hotels closed within Europe. You know, we understand that eventually it will come back. I think it's more a question of when rather than if. I think for the other banks that, you know, that you mentioned that were in the business before, look, I think for that, I presume performance will have to come back again at certain levels, at certain secure levels. If and when that is, I think it's difficult to say right now. But I think the banks or lenders, let's say lenders, obviously, that have been there in the last crisis, during the last crisis, they, I presume, at least with us, remain present as we speak right now. Of course, terms have changed. We're a bit more selective and conservative, but we're definitely continue lending.
James, you're on mute.
Thank you. Just spotted that. Guy, from your perspective, how are you going to deal with trying to evaluate deals with trading performance, which is clearly going to be challenging, and valuation is obviously difficult to equate over the next period?
Yeah, I think we're looking at it from Santander's perspective in sort of 2 or 3 phases. Initial phase, I mean, we came out quite early in March, actually at the end of March, to provide capital repayment concessions, and we actually said there is no requirement and we are formally deferring all valuations up to September. You know, from Rix's perspective, they'd introduced market uncertainty clausing, and we felt at this juncture, if you have a market uncertainty clause in the valuation, it means you have to revalue more regularly. There's less comparables, and we're really looking at trying to support our existing customer base. So in the context of if you're giving covenant waivers, what's the benefit of getting revaluations? We all recognize this is unprecedented. We want to give our clients the opportunity to focus on the operations, focus on how they manage the cash burn, manage through closure. So phase 1 for us is triage, really, looking at the entire book, understanding which of those customers need support. It's very unusual when your entire customer base is turning around and asking you for the same thing at exactly the same time and they need it as quickly as possible. So that has been a challenge. As we've sort of started to come through that, I think phase 2 and the look forward, that's why we're all on these webinars, that's why we're all so hungry for data. We really don't know. Nobody knows. And so when you look and talk to the banks at the moment, we are having discussions at credit committee, and you almost like the Bank of England fan diagram and diagraph. I mean, it could be anything from very positive to very negative, and then it will probably land somewhere in the middle. So for us, it will be around how much can you de-risk that proposal. So if you're looking for something now, then you're going to need to be looking at it based on a very sensitized look forward. And so I think the question around at what point will we be able to give that much more comfort around terms and pricing? It's, well, when we feel there's that much more certainty on the look forward. So we're still looking. You know, we are, I'd like to say we have more capacity, which we don't, but we'd like to be looking at more, but fundamentally at the moment it is back book, supporting as much as we possibly can. I mean, one of the things that, you know, we feel, you know, global financial crisis, the banks were a big part of the problem. We'd like to think in this pandemic, you know, we're well capitalized. We're in a position that we can be a part of the solution. And we are trying our hardest to support, give insight, get as much as possible out to the clients and customers to say, you know, what can we do to support you in this? But I think the key will be we need to start seeing how much working capital is required in reopening. I mean, at the moment, you could have situations where clients are burning more capital being opened than they are being closed. So the idea around how does that look, how much more support do you need? Once we have better visibility on opening and demand, we'll be able to be more confident in what projections will look forward and therefore what we can do to support.
Guy, Shona, from your perspective, coming in from a borrower who's got active deals, you're looking to raise finance on deals at the moment, both development and investment. How are you finding the market? What are lenders saying to you?
James, as you know, we operate across the whole funding market, from senior lenders, debt funds, mezzanine. We look at all options for finance, and there's different messages really across those different lending classes. Everyone is certainly saying that they're still lending. I think for everyone, as we move back into a lending market, the same three things that have always been important in hotel lending are now incredibly important. Where's your asset located? What is your asset? And what's the management team? They're the sort of the three most important things. Now your capital stack and how much equity you've got, just like in the great financial crash, the last recession, is also going to be very important. So most are saying they're open for business. If you're an existing lender, particularly at senior banks, there's a lot of support. You know, we're a family office and we're relationship led with our funders, and that makes a big difference in a time like this. And there's been a lot of latitude, a lot of assistance, even from our existing lenders. Two of our existing lenders, we've even managed to secure new financing on both development and also an existing trading asset which is closed, which is an amazing feat really, and a very good reflection on the banking sector in the current market. Debt funds definitely are lending, but everyone's more cautious. There's no crystal balls here. So, you know, we as a borrower are looking very carefully at how we forecast out. You know, I'd prefer to be much more conservative than bullish at the moment to ensure that we get it right, really.
Thanks. And Elliott, you come at it from a slightly different take in terms of being a debt fund. You haven't got quite the same regulatory consents at the bank, and you're well capitalised in terms of lending. So, what's your take on the market at the moment? Are you still looking at deals? I mean, obviously, most of your stuff is in the development space, and I think that is a different position.
Yeah, I mean, look, having the sort of agility and flexibility, as you say, of a debt fund should allow us, and does allow us, to take sort of advantage of opportunities in the market that there are. And I think it was Churchill that said, "Never waste a good crisis." And you know, I think that, you know, there are good opportunities to jump in. we are primarily development funders, so normally you're sort of you're ruining the fact that you've got to look 2 years hence and think, well, what's going to be and how's the market going to be when the asset that you're currently building opens. Perversely, in the current climate, it's actually quite a luxury to think, okay, I don't have to worry until 2022, because even the most pessimistic of our poll answers, and I think the last but one of the polls that Russell put up was that by the end of 2022, the majority of people do think that things will be broadly back to normal, or whatever this horrible cliche new normal means. So I think for us, we've got quite a few hotel developments on the book at the moment. Obviously, the imperative is to get them to practical completion, working with the contractors in particular to make sure that we get there. There will inevitably be requirements to restructure some of those initial sort of trading period facilities that we offer. But actually looking at new opportunities now, which we're actively doing across the UK, we are UK focused. It's quite exciting because you're looking at assets that the developers are already saying, and sort of going back to the F&B panel that we had just before, historically there will be a requirement for X. Is that actually going to be a requirement now? Are we talking to the brands now and saying, you have insisted on a certain amount of space for F&B, we've never really wanted that, but you've insisted on it. Is now the time to go back and say, can we look at the brand standards and make changes? So I think actually developers that have the opportunity and the liquidity now to be able to take new schemes forward and have quite an exciting opportunity to structure not just the management, but actually the physical building in a way that could take advantage of as we come out of lockdown.
And question then for Guy. I think clearly that the debt funds are a number of them are well placed coming out of this. Do you see that as them taking a much bigger share of the lenders market in the hotel sector going forward, given the regulatory constraints on banks and obviously the back book challenges you've got, or do you think the banks will be back as well?
I think the banks will be back as well. I think the difference now to the level of hotel exposures that banks were sitting on prior to 2007 is, they were very highly levered. And we do have a few of those deals in the market. I mean, we'll probably talk a little bit further about that in terms of ground rents and some of the structures that have been put in place. But certainly from Santander's perspective, we are a conservative lender. It gives us the ability as a relationship bank to provide the concessions as Shona was talking about, because we have the capacity within our funding. And if you are sort of looking on a 2-year look forward and you can kind of put something away in terms of debt and interest and put a working capital facility that can meet that for a period, you can take a bit of a view of Elliott, which is slightly close your eyes, put it in the drawer and really hope that within 2 years, things are going to look significantly more certain than they are today. So I think banks will definitely, and certainly banks that understand operational gearing, trading cash flows with the benefit of security, that understand the class and they like it, as we do, they'll remain. As we know, banks are not, well, I'm prepared to say this, it's not particularly controversial. Larger banks, we're not the most nimble, not the most fleet of foot. So it takes us time and it takes the regulator time. And we will be having lots of discussions. We're doing that already around some of the discussions around what constitutes forbearance. We're saying, well, in this instance, it's a pandemic. You can't say giving capital repayment holidays and covenant waivers are considered to be forbearance. This is pandemic response. And even the regulators, they need to take time. We're all learning and we're all going through and trying to support the economy and trying to support. So the banks will remain, but I definitely think whenever there's a fracture in any market or any situation, the smaller, more agile you are as a organization, the quicker you can move either to take that opportunity or to adapt. So, we are trying to adopt that. We're trying to ensure on the look forward, we're thinking ahead to what that might look like. If we do enter a bit more of a downturn, how can we look to support? So I do think the banks will continue, but I think it's going to take us time. Just in the sense of getting through the back book, making sure everything is where it needs to be, talking to the regulator, and then being in a position to move forward from there. And as we've seen, I mean, it was only 2 months ago, 2.25 sort of months ago, that the world was completely different. You know, we weren't all sitting in children's nurseries and variety of different places. We were just sitting in our offices. So things move incredibly fast. I think that's where the banks themselves have to wake up and realize now's the opportunity. You know, digitalization, and that is a big part of where we were moving to, and this has just moved us forward. It's pushed banks up the line, I suppose, around saying this is something we can do. We can have our branch being able to serve from home. I mean, who would have thought that? So that aspect of it means banks are waking up. That's how, and we will be in the market, but it will take us a little bit longer than the debt funds.
I think James as
Michelle,
well.
obviously sorry, Shannon, we can say something.
Sorry, I was just going to say, I think it's important to remember as well. Guys said that, you know, generally within the sector, it's a lowly levered position, but I think this time what's different with the banks as well is that they're not capital constrained in the same way that they were previously. We've yet to see some of the fallout from COVID with some of the, you know, restructurings. That takes a lot of capital, but there's not the same capital issue that the banks had, and that makes a big difference. It gives a different perspective to credit, etc., when the banks have more of a capacity to lend.
Yeah. Michelle, obviously your loan book's a global one. Are you seeing, or do you think there'll be new competitors emerging across Europe to sort of challenge the lending of the banks more than has been the case?
I don't think new competitors, as mentioned. I mean, we've seen a lot of new competitors coming in pre-crisis. I think to the point before discussed, obviously, we see a lot of funds coming in now, look at alternative lenders in that respect. That, I mean, we're receiving a lot of calls, and to the earlier point, I don't remember who said that previously. I mean, there's a lot of opportunities that come up for funds, both on the equity side, they're waiting for it, but on the debt side, I mean, as mentioned, a lot of parties have left, at least currently, and given the performances and the expected value or drop in values, the lenders that remain in place for the banks are slightly more conservative. So leverages will certainly come down a little bit, and in order to cover that gap, funds will definitely come in. I mean, we've seen that already. We're being contacted by various funds on opportunities that may be too risky for us in general, or too high of a leverage, where they will come in and then sell off a senior piece at the very low level. So I think we will see that more and more, at least immediately, and which obviously will result in a significantly higher pricing for the borrowers at the end of the day. So I think, you know, again, there are certain lenders still out there lending, including us. I do think like immediate transactions that we will see will probably either be all cash transactions, all equity, or either low leverages and equity input, or then with the combination of funds or mezzanine senior lender.
And Elliott, do you think the higher gearing is an opportunity for Puma and the other debt funds out there to really take that market share?
Look, I mean, we've played in historically the stretch senior space. I think the question really is how much you're going to stretch. And in the current market, clearly, like everybody, you know, we are also looking at things in a little bit more conservatively, and certainly sensitizing things a lot more aggressively than we might have done in the past. I think really the debt funds, sort of liquidity, as King Shona sort of talked about, the capital constraints, the availability of capital is key. We are unfortunately seeing already quite a few relatively high-profile debt funds starting to fall by the wayside, whether it's their funding lines have dried up. Obviously, peer-to-peer market is fallen off a cliff. But even those where that's not necessarily the case, managing the existing book, we, like many of our debt fund competitors, are much smaller. So Guy said that gives us the opportunity to move quick, and it does. But where you're looking at an existing book which is blowing up left, right, and centre, we're in a fortunate position where things tend to be, thank God, okay. But if the entire book is all blowing up, there's just not the capacity in a small team in a small house to be able to even think about writing new business, because it's just all hands to the pump. So I think that like any crisis, it does sort of sort wheat from chaff, and I think that there will be funds that do fall by the wayside for various reasons. But for those of us that are able to move forward and have the liquidity, I think it is an opportunity. But we will rarely be playing in the same sort of very conservative loan to value space as the main banks, simply because we can't compete on pricing. So for us, it's about how far up the risk curve are we prepared to go to ensure that we can get the pricing we need without going too high to move into territory that we consider to be too risky.
Thanks, Elliott. Some interesting questions coming in from the audience, so let's deal with one of those. Guy, I know your favourite subject, C-bills lending, and a number of people asking, how's that going to be dealt with? How's the government loans that are being made, how they're going to rank, and how are you going to deal with them? I guess that those all need to be dealt with once we start to come out of this and hotels open up again.
Yeah, absolutely. I think there's obviously, from Santander's perspective, we're accredited for B-bills, C-bills, and CLIBBLs. So all aspects of the scheme. Clearly, from the bounce back perspective, it's up to 50,000, and therefore that's something which is 100% backed. C-bills up to the 5, looking at it from a sort of group consolidated basis, and importantly there, 12 months interest only. So that's a helpful concession with the 80% backing. And then CLIBBLs for the larger turnover businesses, where that can actually now be up to 200 million. So we're in all parts of that scheme, and we are very keen, and we are trying our hardest to give everyone, and be fair to say that whoever is needed and comes and asks, we're looking to provide. We are focusing on our existing clients at the moment, just because, as Elliott mentioned, we are a fairly small team, even though a big bank, and that's a lot that we are currently still working through. So in terms of how will we look at it, I mean, one of the things that we are looking at the moment is trying to provide those government facilities for as long as possible. Actually saying, look to take them 3 to 6 years, even if that's going beyond the maturity of our facility, with the kind of expectation that in the next 2 to 3 years, everyone's going to be carrying more debt. They'll be carrying the C-bills on top of that. Leverage is going to be higher. And we might well be looking at refinancing with an element of that still attached to our debt. So it's difficult to tell now what the appetite will look like on the look forward, shall we say. But we are actively saying, look, if you're looking for longer, good. We think that is sensible. We think it's prudent. To Shona's point, let's put some more sensitivity into your cash flow. Let's see what it looks like. No one wants to take this debt. You don't want to, take government debt to then just pay the banks their interest on their debt. It's debt for debt's sake. So, customers aren't looking to continue to over-lever themselves when their hotels are closed. It's a case of need. So in terms of how it looks, it's around what will we be able to do in terms of on a refi? Is that something that we can extend and keep the C-bills in place? I mean, I think one of the things which isn't always fully understood is, whilst it's a government guarantee, it's a loss share arrangement. So you have to lose money, at which point you then have an 80% recovery. And And that is a slight nuance, because of course it's not saying that it's the 80% first loss piece that the government's picking up. So when we are looking at it, we still have to look at normal, or, you know, when I say normal, credit practice, to say, you know, we're not in the business of losing money. It's very helpful to have that extra government support, but we are also providing BAU overdrafts for customers that are eligible. So I think the view of what it will be as we come through the next 24, 36 months is there's going to be a lot more debt in all of the businesses. So we're looking to restructure those, provide more time to give us all the comfort that you're going to be able to have a runway to getting back to where we think we'd like leverage levels to be. But for that reason, we do feel the level of refi activity might be that much less, or it could be the debt funds, because they could be in a position to go slightly higher up the risk curve.
Michelle, obviously we've been working together on a number of your existing deals where you've provided support. I know that there's a similar scheme to the CBIL scheme in Germany where you can get government loans to support businesses. What's your approach been on those? Are you looking to extend the term? How are you going to deal with the additional debt in those borrower structures?
I mean, you know, obviously we're very busy with our existing portfolio at the moment. I think Guy mentioned before, I mean, there's a lot of, you know, covenants waivers and obviously we're looking at supporting. We're in close contact with them throughout the last 3 months. We are supporting them where needed and looking at helping them were needed to, you know, in looking how the liquidity shortfalls can be covered. Yeah, I think, look, it's a case-by-case basis. Obviously, there's some things we can do. I think there's also a question of, you know, also mentioned before, how we're all trying to figure out what you can do in terms of the, you know, regulations. Again, no one has foreseen quite something like that. You know, all the deals have an issue now, so we do have to do the waivers. But we all know that this is because of the pandemic and not because the hotel or the performance or the loan is bad in general as such. So yeah, we're trying to assist our clients and where needed and to the extent needed, and are in close contact with them.
Thanks, Val. Let's move on. Another question that's coming from the panel, which is when will development finance be back? And I think probably the answer is it is already back in part. Shane, it'd be really interesting your thoughts. Obviously, you're looking to raise development finance at the moment. What sort of challenges are you coming up against there? Are you able to get fixed price numbers out of contractors? How are the lenders reacting? How easy is it to get development finance at the moment?
I think probably the first place to start is, what does your development look like? And to use Guy's phrase, be nimble, and we as a business look to be nimble. I think, you know, we have a lot of experience developing, which helps and starts you in a very good position, but also as an organization you need to look to every part of your development to make it the most fundable. So we're considering every opportunity, every option. There's no silly thing to consider at the moment. We're looking at the planning. It's a good time perhaps to amend your planning, get the tweaks that you were looking for, as we mentioned before. We're talking to our contractors, we're value engineering our costs for every development and are bringing those down. There's also opportunities to negotiate with your contractor. So I think there's lots of opportunity to get the best development you can at the moment. The brands are also playing their part. You know, traditionally they like to get their flags in. The landscape now has changed, and they may be a little bit more relaxed on, as Elliott said, on brand standards, etc. So that's one facet. Make your development the best it possibly can be for funding. There's also the option to look at fixed income. That's you know, the traditional Prem-In type assets. That's also something that people may consider as they move forward. Some of those leased assets, much easier to get funded, where you've got a pre-let in place, for example, which is an option for some. But in terms of approaching the lenders, once you've got your best fit for your development, the landscape has definitely changed. My perception is that whilst we are supported by our existing senior lenders, which it's easy to be when you're an existing client, they're not really in a position to lend on development finance at the moment. There's, everyone's supporting existing clients. One of our funders said we are consumed with the government scheme at the moment, which makes things very difficult. Come back in the autumn. There's that kind of view, whereas the debt funds are a lot more active, ready to lend. Now, it's a much different leverage position, and also, unfortunately, as a borrower pricing position, which adds to your costs. So where you've done value engineering, unfortunately, you might find your financing costs going up. I think that borrowers are reconsidering their capital stack. Is it all equity cash in, or is it mezzanine? Are we looking to increase the debt by going to a debt fund? But that's a very different IRR proposition, where you're looking at, what was perhaps high single digit is now low double digit IRR that the debt funds are looking for. So if you need to fund your development, I think you have to cast your net a lot wider, and it's a different proposition. We're in a fortunate position that we aren't in a rush to develop any of our properties and have the luxury of time to fully consider our options. That's not the case for everybody, and the debt fund and even sovereign wealth funds will take advantage, I think, of this situation and come in to fund. Mezzanine has a place in the market now, more than previously. Not every is a blend with senior and mezzanine a more attractive proposition for a developer. Maybe depends on your cost of equity. We're seeing even some of the debt funds who were very, very aggressive pre-COVID are now saying we're on pause, we're not lending, we're going to wait and see. It's hard for a bank to think about funding a development when there's no possibility of a valuation that you can rely on, and we don't know how this trade up. Everybody's going to have to trade up again effectively. How this is going to look. So the brave funders who take a step into the market, as we have one or two who are prepared to, with us, will stand out in this market. And look, as always, I've said it's about location, asset and management, but it's also development about who's your contractor. I don't think anyone will want to be doing anything without a tier one contractor on a design, fixed price design and build. It's about the relationship you have and your experience, not just in development, but you also need strong operational experience.
And Elliott, from your point of view, when you're evaluating development projects, how have things changed at the moment?
I mean, I'd echo everything that Shona said. I mean, you can tell that she was previously in my position, because she was saying exactly the things that we look for. Look, I mean, the reality is that it's evaluating it in the same way. I think you're just looking at it with an even more, I would say pessimistic, but certainly a more sensitized eye. I mean, contractor is a very good example. Absolutely, the balance sheet of a contractor, making sure that they have the capability to deliver is crucial in any development. But at the moment, especially a development that's going to be starting in the current situation, you need to make sure that they've got the wherewithal and the capability to withstand a second spike if that comes in later in the year or next year. And contractors, the good contractors who you want to do business with are also smart, and they're putting in, you may have seen them, James, COVID clauses that tie into the extensions of time, so that then there's a bit of a haggle as to what is a direct cause of COVID, what's an indirect cause of COVID, and so you can certainly try and sort of protect. They will try and protect, and you as a funder and the developer that you're backing will try and protect themselves as best as possible. But I go back to what I said earlier. For those of us that do have the liquidity, there is opportunity. As a stretched senior player, obviously, I would always try and argue that going with one funder and stretching a bit higher rather than going on the senior mezz and into creditors and 2 sets of lawyers, etc. I know that's good for you, James, not necessarily good for anybody else. It's always sort of trying better if you can to go for the one-stop shop. So I think for people like us, there's opportunity. But it's about just making sure that everything is really sort of focused and thought through and sensitized. We've put a few deals through credit in the last 3 or 4 months. Everybody just goes straight to the sensitized table, right? They don't even read the executive summary anymore. They just go straight to the table and say, what happens if we're 12 months late? What happens if we're 20% over budget? What happens if there's 20% drop in value? And what are we looking at? And of course, that's a very fundamental part of the credit in any scenario. But right now, it's absolutely key. I think the valuation, I think Shona mentioned, a value to what can you rely on. I mean, look, I'm sure that all of the lenders on the panel would agree that evaluation is always worth the paper it's written on and a little bit more, but not enormously. As in, we have to form our own view, right? You don't just stick a valuation in the drawer and say, oh, it's worth £100 and therefore it's okay. So it's about again even more aggressively challenging the valuer to make sure that they have really thought it through and they don't just kind of trot out a standard valuation and put a 3-line carve out on the front page that that says, well, we don't have to rely on anything. And provided they have done their diligence and that it makes sense and to us, then we would be prepared to lend.
So we're running a bit short on time, but I want to squeeze in one more question, which particularly Guy and Michelle, maybe start with you, Michelle, which is, I think the sense is it's going to be easier to finance existing owners who've got a trading history than it is to fund acquisitions. I think the big question going forward is, for those who want to acquire hotels, in theory they may come onto the market with banks enforcing possibly. Do we think acquisition finance is going to be available anytime soon? Michelle, maybe start with you.
Again, I think for lenders that are committed to the asset class and didn't just jump on the bandwagon when because of the cap, because of the higher rates in recent years, that understand the business and that do believe within the recovery. And obviously, that's all, as Shona mentioned previously, it all depends on the location, on the asset quality. I think in Europe, you have different paces of countries, as Robin mentioned earlier. And most definitely, as she mentioned as well, I mean, the operator and the sponsors behind, I mean, for us, the sponsor has always been very important that, he understands hotel business as well. And that has become obviously even more important. So I think if that is right, then definitely we as other lenders that are committed to the asset class and remain or continue borrowing on it, we definitely are looking at acquisition deals at the moment. Again, terms have definitely changed from pre-crisis, absolutely. But if that mix is right, if we feel comfortable with the asset, then I mean we're currently just in the middle of a financing where we're funding into a portfolio of closed hotels, which I think we've never thought of as really, we're not doing development lending, so we've never thought we would be doing. But again, we understand the cycle. We understand that while this time the transparency and comparability may be a bit different than previously, and it's a bit of a crystal ball of when it comes back, but as long as we feel comfortable with the quality of the asset, with the location, and definitely the sponsor and operator, then there are definitely lenders that are comfortable in acquisition financing as well.
And Guy, very quickly, just presumably you'd look at acquisition finance, will you, in the near future, as and when things are back to normal?
Yep, I think cash is king is probably the one thing I'd say. You know, if we're heading into any kind of uncertainty, if there's any kind of recessionary headwinds, as we saw in 2009, and you know, Anthony was lending through that. If you are well capitalized, if you've got the ability to fund from equity, fantastic, because you know you'll be able to move quickly. And if you're able to, what might seem very, very, very conservative levels of leverage, but if you can make that work, you're going to be in a very strong position. So fundamentally, whenever there's uncertainty, it comes down to, you know, the more you have and that ability, it's going to give you the greater amount of options. The alternative, if you need to be more geared, you're going to have to pay for it. So I think that fundamentally just comes down to great opportunities, as Elliott was mentioning, for the debt funds. The banks will be there, but they'll be very conservative. So, you know, if you've got a very liquid sponsor and someone who's coming in, there's plenty of the US private equity who made, you know, did very well from 2009 and onwards. And I'm sure plenty of people will be looking at the market in the next 12, 24 months with that kind of eye. So yes, cash is king would be my sort of closing statement on that one.
Thanks, Guy. If we can load up the final question then, just before we close out the panel. So here we go. So by the end of next year, what type of financing, and this is the one multiple choice question, so you can take as many of you like these, which type of financing do you think will be available in the market? So refinancing by lenders their own loans, refinancing of trading hotels for existing customers, existing owners, hotel acquisitions, development finance, mezz or ground rent financing structures. So if you just tick whichever of those you think will be available. I'll give you a few seconds just to complete those. Results. No, I've got Russell popping up instead. There we go. As a result. So not many people thinking ground rent structures are going to be available, which I think is probably right. If I can say a huge thank you to my panel, particularly those who got up in the middle of the morning to join us. Thank you, Shayla, for that, but thanks everyone. On that, apology to those whose questions we haven't answered. I'll leave Guy and Michelle to answer privately as to whether they're out to sell off their loan books for cheap to the person who raised that question. And I'll hand over to Russell. Thank you very much.
Thank you so much, James. I'm sort of hoping that they're going to give me permission to start my video. So if you wouldn't mind doing that, please. So there we go. Ladies and gentlemen, please join me in thanking our panel so far. And welcome to our session, the final session of the morning. And we've got 4 distinguished panelists here to get their views across. We've got 35 minutes. We're going to need all 35 minutes, so please stay with us. We've got some questions for you guys at the end. And I do want to stress that whilst I've got some questions prepared, I do want to put your questions to the panel if we possibly can. So it's time for delegates to do some work, please. We've got a poll question for you just to kick things off. If we could show that. So what is the most likely break-even occupancy for hotels in your experience to be able to be reopened with confidence? Is it going to be less than 20%, between 20 and 30%, 30 to 50%, or over 50% occupancy? So what do you think the most likely break-even point will be occupancy-wise for hotels to be able to be reopened with confidence? So if you send in, so you reckon 30 to 50%, we'll see what our panel thinks. I know Frank's got an interesting way of expressing break even. We'll get on to him in a moment, but please join me in welcoming, at last, I have to say, Karen Friebe, partner with Bird & Bird, Frank Croston, partner with Hamilton Hotel Partners, Coley Brennan, a partner with KSL Capital Partners, and Marie-Paul Nolis, the General Manager of the Sofitel London St. James. Welcome all. And I'm going to start with a question for all of you to jump in with one particular aspect of the following question. So let's focus on what currently closed hotels need to be doing to prepare for their eventual reopening. So I'd like you to choose one aspect of what they should be thinking about, perhaps what's uppermost in your mind as they prepare or they are prepared for reopening. Marie-Paul, you're in the hot seat. You're the real frontline hotel operator at the moment. What is the most important thing that you're focused on? And please just stick to one.
Get our team prepared to work completely differently. I think that's the most important. It's a huge change of mindset. It's really a cultural change.
And some nodding faces there. Frank, what's your advice, or what are you doing most other than that, of course?
Well, I think the whole area of staffing is the central area of concern and area of focus, because it's quite challenging at what's expected to be low initial levels of volume to communicate effectively with the staff as to when they can expect to come back to work, and from a management perspective, how we can deploy them equitably. People don't like uncertainty, and they are concerned, even if they're furloughed, to navigate a path back to normal. So I think the big focus is on over communicating with the staff at the hotel, and having, which I think all of the operators have now done, very clear protocols and policies on not only keeping the guests safe, but also keeping the staff safe.
Interesting. Karen, I know you're not a full-time employment lawyer, but just sort of put that hat on for a second. What are the key issues from the staff perspective that you might be advising your clients about?
From a staff perspective, one of the things that we're clearly looking at is the fact that social distancing is going to be a huge issue, and there will be directional signs in most hotels, I think, and there will have to be social spacing, and I think that will be quite a challenge for the staff as to how to police the regulations effectively to make sure that social distancing measures in particular are properly implemented. And I think there's going to be a greater use of technology. We're already seeing that coming from countries like China, where hotels have already reopened, where we're seeing that the hotels are being asked not to have as much social interaction with their customers as perhaps the demands of hospitality had dictated to us in the past. I think there's a bit of a dilemma here, I think, between hospitality in its most traditional sense and service, and what hotels are going to be able to deliver in the new world.
Thanks. Colleague, back to the original question without my diversion to Karen on staffing. What is, if you like, uppermost in your mind as you're preparing hotels for being reopened?
Yeah, I thought the exact same thing as Frank and Marie-Paul on that. I guess so that I have a somewhat fresh perspective. The other way we are thinking about that is management training. It's one thing to think about the frontline staff, but it's also, to Frank's point, a completely different world in terms of staffing, scheduling, thinking about how you motivate, recruit, and retain talent. There's a lot of broader HR aspects that are front and center and frankly, quite new.
Interesting. Closing was relatively straightforward, and reopening, we accept, is going to be quite challenging. But in your planning, in your thoughts and so forth, as you're looking forward to the reopening or to the increase of business for those hotels that have managed remain open. Are you really thinking that there could be a second wave? Are you really thinking that you might have to go back to square one? Or are you relatively confident that the business will continue without that particular step? Frank, maybe you'd kick us off on that. And please read.
Yeah, sure. I mean, I'm not an epidemiologist, or however you say that word, but it seems to me that we are winning the battle, and the number of infections and the number of deaths is shrinking. And I know that there have been countries around the world where there have been second outbreaks, and I would anticipate that any further lockdown-like measures will be localized rather than general. But in terms of the main thrust of your question, our focus is really to make sure that when the hotels reopen, they are either making money, which would be great, or losing less money than they were when they were closed. And from an ownership perspective, that's the only logical point at which to reopen. It is going to be challenging to pick the moment because there will be incomplete information available. We will be scanning the environment city by city to look at business on the books using tools like OTA Insight and Demand 360. But there's also the reality that if you're not open, people can't book you. So at some point you have to step off the end of the plank and dive in. And we are envisaging staggered openings in the UK, for example, not planning to open all the hotels at once. And we have a schedule based upon our anticipated view of the resurgence of demand. We reopened a hotel in Germany 2 weeks ago, and I'm pleased to report it's a spa wellness hotel that it's doing 100% at the weekends.
Wow.
So it can surprise you on the upside.
So that's great to hear. Marie-Paul, presumably you don't have much choice as to which of your hotels to open. You've got one. But how are you going to ensure that your business is going to reopen and immediately achieve a positive cash flow? Picking up on Frank's point, you don't want to be opening and losing more money than you're losing already.
Yeah, it's quite complicated because I think currently the 14 days self-isolation don't help us because no one is going to book London as long as this is implemented. So clearly we are waiting the end of that to set the date of the reopening. There are two things that we have for us. I think, first of all, we have a strong percentage of loyal guests. So if we are, again, and I'm very humble in that, if we are able to succeed in the new protocols, the way that we are going to implement them, but also the way that we rewrite the entire guest journey, because this will be completely different with social distancing. And for that, we need to have a very strong, engaged team. The team has really to be behind us, strong communication with our owners also. And so once we have all that together, hopefully we can have a date. Is it over the summer, end of the summer? I think it's so far we cannot really give a date out yet, but and make sure that we will lose less than when we are open than right now.
That's very sound. Coley, from your perspective, you have different locations to contemplate and different types of hotels. So what's the key focus in making sure that you can reopen profitably?
Yeah, well, it's interesting. Tying back to the last question, given we've got hotels around the world at different price points, different product offerings, et cetera, we benefit from a lot of insight. And as we think about focusing on returning profitably, there's a lot of aspects to that. There was an interesting poll you started with, the 20 to 30 or 30 to 50%. I think that had you asked that question 4 months ago, you would have had very different answers in terms of what level actually means profit. And so our focus is really, as we think about staffing, as we think about reopening and trying to assess demand, and understanding that our margin of error as we assess that demand is much higher than it's ever been probably. So taking that approach, I think that we are trying to focus as much of our cost structure and reorient it as turn as much as many elements of the P&L into variable as possible. That's not always as easy as it sounds, but that's definitely our focus. It's really on cost structure. To one of the earlier sessions on food and beverage and restaurant, I agree with the comment about simplifying menus and keeping the best sellers. And that's you can kind of expand on that, not just within the restaurants, but other aspects, just simplifying the product offering and kind of getting back to the basics.
Thanks. Karen, just sort of picking up a little bit on what Coley was saying in terms of trying to make sure that the cost structure is such that as much of it as possible is variable as opposed to fixed. Clearly, the one element that might start to impinge upon, and I'm sorry again to come back to staffing, but in terms of deciding whether or not to bring some people back from furloughing, and perhaps taking the decision that longer term, a number of those people are not going to be required. To what extent do you think that hotels are going to be flexible and capable enough to be able to do that?
Well, from what I've seen at the moment, so we've been doing a lot of advisory work, particularly with hotel management contracts on freezing hotel operations. And I have to say that our clients, particularly our owner clients who've been having to deal with hopefully reasonably temporary closures, they are all looking forward, I think, reasonably confidently. None of them are saying, well, we're just shutting up shop and we'll have to wait and see. There's a lot of forward planning going on because most of them don't want to be left behind when the market picks up. So I'm quite surprised in a way that there is so much confidence in the market. But I think everyone is being understandably cautious about how many staff they need to keep at the moment and how many staff that they will need to bring back in to ensure that the business can operate effectively once they're allowed to reopen. And I think inevitably there may be staff cuts that have to be made. Although, you have to balance that obviously with providing a good competitive service.
Okay, I'm going to take you into a greater area of your comfort zone now. You've been playing the employment lawyer for too long. So let me kick off with you in focusing on and ask every member of the panel to respond after you. But I'd like one particular change that you feel that either leases or hotel management agreements will need to change to provide for the possibility of further instances of pandemic or just to look at what will become the new normal. What do you think leases and or hotel management agreements will need to have changed in the future? Karen, please.
Well, certainly hotel management contracts. One of the first things that we've been asked to look at is the termination position and what does my force majeure clause say? Surprisingly, some of them already do legislate the pandemic, others don't. And I think it's going to be essential whenever you're negotiating a management contract at the moment to make sure that there is proper forethought has been given to this kind of incident because it's likely to happen again. And the management contracts that don't legislate for it at the moment are the ones that have led to a greater degree of nervousness, I would say.
Okay. Marie-Paul, do you want to jump in with anything that relates to the management contract that you're operating under?
Yeah, I think on our side, what is critical is the way that you work with your owners. That's really because on a day-to-day, I think I work much closely with our owners than I would even do with people from the management company. And that's also because it's critical that we take some of the key decision on reopening, the way that we are going to manage afterwards, that we are completely aligned.
Okay, so your owner is, let's say, more hands-on. Is that how you are, Coley, or is there an aspect of this particular topic that you feel really needs to be addressed, either in terms of leases or in terms of HMAs?
It's an interesting question, and I'm not sure I totally identify with the position that much needs to change in the contract. I think what needs to be potentially have a greater focus is on the relationship and the dynamic of owner and operator, and to your point, decision making. Our perspective, and I suspect Frank's in the same boat, for the assets that we own where there is a third-party manager or there is a brand, we've been very careful to ensure that we have an ability to impact decision making. And this is kind of, the top of the type of decision making. The contracts that we're involved with, I think, are working quite well in different corners of the world today. So I feel confident about that. You're right, this will happen again. It's not a matter of if, but when. It's just a question of, is it, within the decade or not? So I feel actually as an industry post GFC, a lot of positive changes were made and created to that manager-owner relationship. And I think it's actually somewhat easier for folks like ourselves or Frank to actually be effective in our roles.
So Frank, are you in the same boat? Are you aligned with Coley, in violent agreement with each other?
Yes, in fact, I would go a bit further and say that the contract is almost a necessary irrelevance, because this is all about relationships and communication. And we have found, both as an asset manager and as a manager, that good communications is the key to making the owner and the manager feel involved, engaged, and valued. And this is not the time for a manager to be going off making decisions autonomously, because the owners are actually funding all of this, so they have to be engaged. And then on leases, I think leases are going to be the biggest area of potential change coming out of this, because it's really demonstrated that people who've signed up to relatively low coverage leases are tremendously exposed, and that they don't have a bottom, if you like, that they have to keep paying the lease even with some forbearance when there's no income at all, and when income spends 2 years building back to where we were. So I think structural change is required to the typical lease arrangements, which kind of requires a lower base and a higher variable. The return to owner shouldn't diminish if the numbers predicted are hit, but the shape of that return needs to be more equitable.
Okay, I'm going to pick up a couple of questions from our distinguished audience. Is anyone on the panel aware of insurance offerings that would cover force majeure events occurring which may inhibit rent obligations under a management agreement? I'm not quite sure what rent obligations under a management agreement means, but anybody aware of insurance that covers force majeure? Quick yes or no?
I just heard that this was in France. This happened just recently, but I didn't have the entire detail. But I just heard that it's a case for some insurance in France and some hoteliers. Yeah.
Okay, vive la France. And I think this
issue, Russell, is that most insurance, there's a requirement for there to be physical damage as well, which is what the big problem with reclaiming insurance proceeds.
Not just throwing your computer out the window. That doesn't count, I guess, in your case. A quick question. I think I'm going to suggest that it might be Mary-Paul, but with ongoing childminding and shielding responsibilities for employees, shouldn't hotels promote job sharing schemes rather than implement wholesale redundancies? This permits future flexibility. Actually, three of you can probably jump in with an answer. Anybody want to take it?
I can start. I think we have to be creative here. By the end of the day, what we want is really to save all the jobs for our current team. So how can we work that differently? In the past, we worked with agencies, we had third parties. How can we make sure that now the manpower that we have at the hotel is used differently? And that's just what we have to do. And again, being creative, think out of the box. And yeah, we have a couple of options in mind for that.
Okay, I'm going to move on if I may. There are indications that there could be some significant additional costs to implement the various hygiene, cleanliness, social distancing measures that hotels are having to deal with. And there is a question as to whether guests might be asked or even be prepared to pay for some of this, or are hotels just expected to absorb these costs entirely? What are you doing about this, Coley? You adding a
Yeah, we've been having this conversation globally. I think the short answer is the consumer expects the service provider or the product provider to absorb that cost. I think that's appropriate, and I think that's fine. I think to Marie-Paul's point earlier on staffing, there's a lot of creativity, there's a lot of flexibility. There's a lot of passion for performance really across all of the people that work within our organizations. And I think that there is an expectation that things will shift and things will evolve, and there will be trial and error. And some of the things that cost a lot day one may not be relevant on day 100. I think consumers are going to be sympathetic to some of that and empathetic. I already see it on the few shops on the high street that are open, largely takeaway food, etc. So short answer, no, I don't think we're not expecting within any of our businesses to pass that cost through.
Any aspect of your hotels, Frank, or Mary-Paul, from Accor's perspective?
I'm not convinced that it will be an overall cost increase, because there are counterbalancing cost savings, because I think guests are quite likely to want their room serviced less often, or maybe even not at all, and they'll just stick the do not disturb sign on and ask for nobody to come into the room while they're in residence. All movable collateral is going to be stripped out of the rooms for the foreseeable future, just because it could be a source of infection from guest to guest. So that's a cost saving. Yes, the hygiene measures have to take priority, and there is a cost, but there are compensating savings. So I think they should be targeting net zero.
Interesting. From Accor's perspective, or from Sofitel?
I can only echo what Frank just mentioned. I think we have to be, when I say smart, and stay pragmatic about it. It's not about adding layers and who will make the difference. It's also by continue to provide an experience, and we can provide an experience with taking some collaterals out there, but having a strong interaction with our guests, with the social distances. I think it's not antinomic to have that and to do that.
But can I just say, Russell, as well, that I was just going to add very briefly that, going back to pick up on Mary-Paul's point about the 14-day quarantine, hotels in the UK, I expect, will want to have their pricing as competitive as possible to benefit from the staycationers who will presumably be holidaying in the UK instead of going abroad.
Okay. How many of the panel, just a quick straw poll, how many think that this government in the UK will have capitulated by the end of the month and removed that 14-day quarantine?
If not by the end of the month, shortly thereafter.
Oh, I like the fence that you're sitting on, Curly, by the way.
Okay, we will just lose an additional month if they do that.
Yeah, I mean, this is not a political statement. I just think that they need to wake up and smell the coffee. We're getting towards the end of our session, and I apologize. I'm just going to trawl to make sure that we have, as it were, dealt with our wonderful delegates. What percentage, if any, and which tier of hotels do you think might be planning to repurpose their hotels to non-hospitality assets? Anybody want to take a punt?
I'm hearing a lot about adaptive reuse, and that's most logical for hotels that are at the end of their physical life cycle, but in good locations. And maybe they are going to find it more challenging to re-enter the hospitality market whilst that market is in distress. So it remains to be seen which adaptive reuse is most appropriate, but I'm a big believer in this recovery phase in a move by consumers towards a preference for extended stay type offerings.
Right.
You know, being able to control your environment is likely to be of interest to the guests more so than in the recent past.
Okay, a quick follow-up question. Sir James asks, how long will you keep rooms vacant between guests? He's seen 24 hours to 72 hours. Anybody want to pick up on that? I know you've mentioned it, Frank, but Marie-Paul, Curly?
If you're at 50% occupancy, by definition, you've got the benefit of 24 hours between guests. And if that's kind of our target for the immediate term occupancy levels, being practical, we've seen no evidence, we've heard no direction from any health body indicating kind of any specific time period. So there's no blanket level across our organization. I think as you grow occupancy, hopefully that's a good problem to have.
Okay, I'm afraid I've reached my final question for our panel, and I'd like panel one-word answer, please, to the following question. So even if a vaccine is successfully found, what do you think the most likely structural changes to our industry in the short and the longer term will be that arises from COVID-19? So one thing in the short term, one thing in the longer term. What do you think the most likely structural changes are going to be? A one-word answer from each of you. I'm going to take ladies first. Marie-Paul?
I would say the virtual meetings, what we do right now, this will remain.
Okay, and is that longer term as well?
It will remain, even if we cannot wait to meet each other again, but we will continue to work differently.
Okay, Karen, what do you think?
Not quite one word, but something we haven't mentioned yet and which is inextricably linked with what's going on at the moment is sustainability. And I know that many hotels have already started that journey. Some are well into the journey with no longer having single-use plastics in the rooms, but the whole debate about what's happened here with the pandemic and what's happening in the world are so closely linked. And I think we will see a much bigger push for hotels to be sustainable. And indeed, the generation that's coming along that we want to attract to our hotels will expect that.
Okay, closer to one word from Frank, please.
About 50 words.
In the short term, I think you'll see far leaner structures in the management companies. I think that they will have to do the same work, if not more work, with fewer people, because that's just the economic reality that they're facing. And in the longer term, I think the redrawing of the basis of lease agreements is an inevitable consequence of the recent experience.
Wonderful. And Coley, final words from you.
I'll keep true to the question. Short-term efficiency, long-term closures.
Interesting. Ladies and gentlemen, in our esteemed delegates, I want you to thank, please, our panel for this morning. And please, now let's get the next question for you to answer. If you can put that up, please, guys in the back room. After how long do you think it will be before hotels are operating at 50% occupancy or better, after authority is given for them to reopen? So, are we talking about 2 months? Are we talking about 4 months? Are we talking about 6 months? Or is it going to be 12 months or longer? So, if all of you could please respond, that would be wonderful. And most of you think that it will be 6 months. So thank you so much indeed. I'm going to hand over to Chris to start the final closing remarks and so forth. And I'll see you in a few seconds as well. Thank you.
Thank you. Thank you, Russell. That was a great session. Very, very, very engaging. So well done. It's been a fascinating, I think, morning. I personally found this a fascinating morning. This morning, and actually we seem to have covered a lot of different topics. Firstly, starting with Paul Slattery's presentation, which was certainly fascinating, how it both touched on both the social dynamics, the economic dynamics, how it touched on public sector and private sector, and probably set out quite a number of alarming messages as well, which is quite interesting. Robin's as well, and followed, which also was quite fascinating, a mixture of both optimism and pessimism at the same time. But it does highlight the challenges we're going to face as we come out. And it is going to be clearly, I think as polls show as well, quite a long road back to recovery. Russell, would you agree on that?
I certainly would. From my perspective, I think we had the situation where Paul was doom, gloom, and then some. And I do advise everybody to avoid going to the top floor of tall buildings for a while. Robin was slightly less gloomy, almost a glass half full, which is good to know. I'll certainly be following up with him just to make sure we're all aligned with some of his thoughts, which was of course, interesting. We then had, of course, the F&B panel, a wealth of experience with all of them, or almost all of them, looking at how much grey hair was in evidence. They've all been through more recessions than we've had hot dinners, and it looks like we might be having hot dinners soon. So it was good to hear some of the conclusions coming out of that. And of course, the banks, they're open for business, but be patient. Life is moving incredibly fast, but it doesn't mean that necessarily all the banks are moving incredibly fast as well. I'm a bit concerned that many hotels need to assess their cash flow and make sure that they can open with confidence and make money. And I think that might be something that Chris and Karen and I will follow up with an even more in-depth look. But overall, it was great to see so many new faces on the panels, and especially to see the male-female balance being addressed so positively. So please allow me to thank, if I may, all of the many people who have joined us this morning, and to our delegates as well for pitching in with your questions, but also answering some of our survey questions. And with that in mind, it's a pleasure to ask Chris to take us through another couple of questions. But maybe if Karen wants to join us and say hello and goodbye and whatever beforehand, that would be fine as well.
Hi, Karen.
And can I just add, before it's forgotten, Russell's very nice comment about male-female balance. It would be remiss of me not to mention something that will be on the radars of many of the women on this call, that very recently we have been trying to advance the causes of women in the hospitality sector generally, and only in very recent weeks a fantastic mentoring scheme has been set up and a related WhatsApp group. I've taken on a mentee, and I know that a number of senior women in the sector have done the same. And this is all through the efforts of the amazing Lisa Engel. So if that's something that any of our female delegates on the line would like to hear more about, please do drop me a line, because it really has been a really quite amazing thing. And with a lot of people losing their jobs in this current situation, we're finding that women are coming to us and saying, I've been made redundant, I was a senior development director, please can I have a mentor to communicate with and to help me? So please let me know if you'd like to know more. We'd love to have more women join the group.
Thank you. Let's ask the next polling question, shall we? Alex, are you okay? So what proportion of governments in Europe do you feel truly understand the impact that the hotel and hospitality sector has on their country's GDP and employment?
I'm going to be very interested to see the result here.
Wow, that's quite interesting, isn't it?
Yeah, yeah. So not very many is the, could do more. School report time.
Well, we've obviously got to make a bit stronger argument as well, so we better start doing that. And the next question, please, Alex. How important is the establishment of an effective contact tracing system to enable travellers to be more confident about travelling domestically and internationally? Yeah, essential, 34%, very interesting. So about 60% either essential or very important, so which obviously says a lot about how we have to rebuild confidence. Thank you. Russell, can I hand to you?
Sure. So having listened to all the sessions, we've got a couple more questions that we previously asked you. So if we could put up the first of those. So when do you now think that hotels' occupancy levels in your location will be back to where they were in 2019? When do you think occupancy will be back to 2019 levels? And if you've changed your mind, that's perfectly okay. And then the final question. There you go. So 2023, I think that's the same as before. So I don't think there's been a major shift, but we'll certainly look at that. And where do you think average room rates now are going to be coming back to 2019 levels? So again, if you've changed your mind, you're allowed to. So let's see what the result of that is. So the same, so 2023 and 2023 again for rate. So no lag between occupancy and rate, which I wouldn't say is necessarily indicative of what has happened in the past, but everybody's entitled to their view, and that's why we've asked you. So may I just add my thanks to those of my two colleagues here, to everyone for having joined us this morning. It's been a real pleasure to have got so many people joining and to have your views coming across. We'll be following up with some information, the slides and so forth, and maybe something in writing as well to accompany that. So look out for when we do this again, and have a great morning or a great afternoon, depending on where you are in the world.
Thank you, everyone.